Hi there. This is a quick message that this podcast is general financial advice only, meaning it is not specific to you, your needs, goals, or objectives. We suggest you don't act on this information until you've spoken to your professional financial advisor. You'll find our full disclaimer, link to our financial services guide and website in the show notes below.
Hello and welcome back to the Invest in the Journey podcast. My name is Taylor and I'm the Communications Manager here at Munro. It's hard to believe we are rapidly approaching the end of 2025 and we are coming out with a few pieces of end-of-year content so that you can choose your own adventure. And this is our podcast to talk about the year in review and the year coming up. I'm sitting down with Nick Griffin, our CIO, to talk about those two things, the year in review and the market outlook for 2026. Nick, we've been doing this podcast for a few years now, and last year when we sat down, we came out with the famous A-Team podcast where you spoke about the team having a good plan in 2024, and that's why 2024 was so successful. So my first question is, for 2025, did you have a plan going into 2025, and did the plan play out?
Yeah, so maybe I should just remind everybody what I meant by the A-Team.
Yes, please
for anybody who wasn't born in the 70s like I was. But during my childhood, there's a show called The A-Team, which they've redone. And it's about a bunch of mercenaries who solve problems in the world. And there's a famous guy in it called Hannibal. And at the end of every episode goes on some horrible adventure. But at the end, it all turns out. And Hannibal says, I love it when a plan comes together. And that's what I talked about last year, because last year was a very strong year for our funds. 2024, our worst performing fund did 37% last year, and most of them did better than that. Some in the 40s, some in the 50s, one even in the 60s, the climate fund. And so that was a plan. I love it when a plan comes together. What we talked about last year, if you go back and listen to it, and you can, it's on the record, the beauty of the digital age, you can actually go back and listen. We said 25 would be another good year. We were set up for double-digit returns from markets, but it would be significantly more volatile. It was a classic third year of a bull market. The first 2 years are always the best, being 23 and 24, and thankfully we managed to collect those. And that 25 could still be a solid double-digit year, but it would be more volatile. And that's ultimately what's happened. It has been a more problematic episode of the A-Team. More things have gone wrong. But ultimately, as we get here to the end of the year, we have double-digit returns across most of our funds. It hasn't been the straight line that we predicted it wouldn't be, but ultimately our processes have stood up throughout the year, and double-digit returns, I think, is a good outcome after last year in what could have been a banana skin year for us.
And so, as you mentioned, 2025 was a volatile year, and it started almost immediately in January with DeepSeek, and then Trump came along with his inauguration, and then obviously later in April, Trump's famous Liberation Day and the tariffs. Can you talk us through how the team navigated all the twists and turns that came with this year?
Yeah, so ultimately we came into the year very much, and again, if you go back and listen, with things will broaden out this year. Rates should come down. The economy should get better. And, that the year won't be dominated by just AI like it was in, say, 23 and 24, and it won't be dominated by big cap tech. It'll spread out to small and mid caps and other areas. That was the plan as we came into this year, and ultimately that plan got, DeepSeek was sort of just a narrative that went away, but ultimately Liberation Day sort of, it did puncture that plan. The reality was that the tariffs that the Trump regime decided to put in first, ultimately stunted the economy in 2025 and stunted it reasonably dramatically, particularly at the consumer level, and particularly, in some of these other areas of the market where you're relying on rates to come down and growth to get better. And so ultimately it ended up being another narrow year, to be honest. And so what we had to do through Liberation Day is we had to lean into our stop loss process. We had a number of companies triggering through that period. A lot of them were focused on the consumer. Some of them were focused on infrastructure build-outs, et cetera, part of this broadening out theme. And we ultimately decided to step to the sidelines on a number of those stocks. The one area where we didn't think that the Liberation Day would affect was the AI spending. And so we actually ended up leaning back more into the AI spending, and that happened to be the right thing to do, particularly in between that April and October period. And now as we come into the end of the year, which I'm sure we're going to talk about, AI is apparently a bubble and we're having another correction. And that's fine. That's fine. And so this is something, you're going to have to get used to. This volatility is going to keep being around. And we're going to lean into our stop loss process to try and work out if the facts have actually changed. And so I think with a lot of the things you're talking about through the year, a lot of them are sort of narratives and some of them are the facts have changed. And so the real trick for us is, have the facts actually changed and we should change our view, or the facts haven't changed and we should hold our view. And so from that point of view, we held our view on the AI stuff and it worked out well for us. The facts changed on some of the consumer stuff. We stepped to the sidelines and that worked out well for us as well. If anything, you're now moving back to that. I'm sure we'll talk about, 26 probably sets up like we thought 25 would, but we'll talk about that in a second.
Yes, we will. And before we get to AI, which I know a lot of people want to hear about, can you mention any other portfolio decisions that you made throughout the year that were particularly meaningful or differentiated structural growth?
Yeah, so when I go through and we obviously do this as a team, we go through the returns for the year at the end of the year, and the returns, as I said, have been good. And if anything, there's actually been a bit of a currency headwind this year. So the underlying stock returns are even better than what you see in the performance of the funds. Look, from our point of view, the big pivots that we did is really more towards power on the AI theme. Power has been a very, particularly with our climate area of interest, and you'll see our climate fund is actually, again, our best performing fund this year, because power is the big bottleneck in AI, and that is where a lot of the returns are going, where people are spending, excess. These companies getting excess returns to ultimately connect data centers. And so that's things like gas turbines, that's things like grid investment, that's things like nuclear energy. And so that pivot worked very well for us. The second area that worked well for us throughout the year was obviously defence. We've continued to see the structural growth in defence spending, particularly in Europe. That worked out well for us the year. And then the third areas I'd talk about is, really during that liberation days is pivoting towards earnings certainty. Helped us get things like Netflix right, which performed very well for us for the year. And ultimately, we actually exited that in September because it had got a bit ahead of itself. And then some of our healthcare ideas like Galderma, et cetera. So pivoting towards earnings certainty through that tariff drawdown ultimately drove some good areas of returns outside of just AI. And then also the pivots we made within AI worked quite well for us as well.
So moving to the question I think that a lot of people want to know is around AI, and we were early investors into AI, and the question that keeps coming up, and there's a lot of discourse on whether or not AI is in a bubble. Do you have any thoughts on this? Did events throughout November change your mind? Where are you sitting on this?
Yeah, so as you pointed out, we've been here for nearly 3 years now, and we've been investing here, and we've owned NVIDIA for 6 years, and so every year at the end of the year, people go, surely NVIDIA's done now, and next year it still provides us with some good returns, as do other parts of this investment. We would argue that AI is a big structural change that's flowing through the economy. We're seeing this big structural spending, and we should position ourselves in the companies that enable that spending, if that makes sense. If you're going to spend $1 trillion building data centers, then I think companies that help enable building those data centers are probably going to be good investments. No different to what we did in climate a number of years ago, and no different to what we've done in tech. But the other thing I'd say is, look, like any good investment, and you're going to see this a lot, and we saw this a lot this year, it's going to get ahead of itself. Like people are going to get ahead of itself. People are going to question it. People have questioned the AI spending, 4 times now in the last 3 years. And I think they'll continue to question it. I think the question you've got to ask yourself, though, is are they going to stop spending? And we just see no evidence that the hyperscalers are going to stop spending, regardless of what the stock market says. And if they keep spending, then that spending will equal revenue to the companies that enable that build-out, which is going to equal earnings growth. And stocks ultimately follow earnings growth in the long run. And I think from our point of view, some of these things are narratives, and that's good. And sometimes it's just the stocks have got ahead of themselves, and I think that's good also. And so from our point of view, not unhappy to see these stock companies consolidate for a little while, not unhappy to see a bit of healthy skepticism here, because that ultimately means the boom, as we call it, not the bubble, it's probably going to run a little bit longer. Last thing I'd just say is, generally when you're talking about a bubble, you're talking about a valuation bubble. And a valuation bubble, I've been through one of these in 99, they're really big. The market normally goes up like 90% at the end and nothing makes any sense. There are definitely portions of this market throughout this year that didn't make any sense, like quantum computing or new nuclear builds. There is definitely froth going on in certain parts of the unprofitable part of the market. And again, that's normal. And if anything, it's nice to see that froth taken out. But if you look at the biggest companies in this opportunity, be it NVIDIA or Microsoft or Apple or Meta, and even if you go down the curve to, sort of an AMD or a Broadcom, and some of these power plays, not one of these companies is trading at more than 30 times earnings. And so there isn't actually a valuation bubble here. There might be a bubble in spending, but you'd have to believe that they're going to stop spending, and we don't think they're going to stop spending. And so will the boom eventually end in a bust or a bubble? It might. But it's definitely, there's nothing we can see here today that suggests there's a bubble. We just see this as a healthy consolidation and what's probably a long-term structural trend that we would like to participate in a balanced way.
And so we've covered quite a bit of the year already, and you've mentioned some highlights. I would love to know, what were some challenges or your biggest learnings throughout 2025?
Yeah, I sort of touched on this a bit, and I thought about this a little bit on the way here. What's happening in the market right now is you're getting a lot more retail investors in the market, and you're getting this concept of the narrative is actually becoming quite important. So most of my career, in fact, my entire career, and what we do at Munro Partners is we invest in earnings growth. So if a company makes more money every year, we generally find its share price goes up. And so if earnings grow structurally over a long period of time, then the share price ultimately follows its earnings. And so many people have seen me show the MasterCard example many times. NVIDIA has been a great performing company for us because its earnings grew dramatically. We can actually buy NVIDIA today for the same multiple we bought it for in 2018. So it didn't get overvalued. It's just earnings went up a lot. Stocks follow earnings in the long run, period. And that's effectively our North Star. What's going on in the market right now is these narratives. And so these narratives are like changing all the time, and they're causing stocks to overshoot on the upside and also overshoot on the downside. And so I think the big learning for us, and something we talk about a lot as a team, is run a really balanced portfolio so you don't get pushed around by these narratives. But secondly, lean into these narratives. If they give you a great opportunity, you should take it, and vice versa the other way around. And so I think the best example I can give you here would be Google. Google basically spent most of last year with this narrative that search was dead and that OpenAI or ChatGPT or Perplexity was going to take over Google and we'd never search anything again. And, comfortably ignoring that Google actually has the best, or if not the second best AI business in the world. It has the best, or if not the second best AI model in the world. It has Android, which is the best funnel to use that AI. It has Waymo. It has a massive cloud business. So everyone just comfortably ignored this with the narrative and sent Google down to 15 or 16 times earnings. And then what's ended up happening is the search business has actually got better because of AI. The cloud business is accelerated because they control TPUs. Waymo is growing around the world. And ultimately the narrative has flipped the other way and the stock's up 68% this year. And this is Google, top 5 company in the world, right? So this narrative is really pushing these stocks around and ultimately creating really good opportunities if you've done the work around the earnings. And our job is to continue to do the work around the earnings, use earnings as our North Star, and then take advantage of these narratives, because these narratives, trust me, they're going to keep changing. The bubble that we currently have will probably be a boom this time next year, and then it'll be a bubble again the year after that. And we should take advantage of those narratives and really just hold on to our North Star, which is earnings growth, because earnings growth is going to drive stock prices in the long run, and that's what we care about. And
so where are these narratives coming from? Is that being driven by the media, or is that coming from analysts?
Everyone's got a podcast, Taylor.
Yeah.
Everyone's got a podcast. And so you can spend the whole weekend listening to podcasts and people's different views, including ours, if you're still listening. And, it's coming from the media, et cetera. But, AI, this is an exciting time. I mean, this is like Game of Thrones stuff. It's exciting. It's like a soap opera. I feel like I'm trapped in a soap opera sometimes. And it's like Game of Thrones. Who's going to win this? These are the biggest companies in the world going head to head at each other. It's really exciting stuff. And people are really interested in it, as are we. I would just point out, if the biggest companies in the world are going head to head at each other on this stuff, they're going to spend a lot of money. And so let's invest in the enablers of AI and keep this really simple. And that's the earnings growth that we're trying to align ourselves to, rather than bet on any particular one winner. But yeah, it's exciting. It's a soap opera. It's a soap opera that's going to continue into next year. And yeah, you asked what the learnings are. The learnings are is we need to lean into our process around earnings growth and take advantage of these narratives, not be pushed around by them.
And so, as you say, this is going to get ahead into next year. Can you give us your view of how you think 2026 will start off before we get into the macro?
Yeah, so let's go big picture. Okay, so if earnings growth are going to drive stock prices, then ultimately your view on 2026 has to have a view around earnings growth. Okay, and so from our point of view, earnings growth for the broad market should accelerate next year. And the reason why I say that is a number of reasons. The first is that interest rates are lower now than they were a year ago. So that ultimately creates stimulus for the broader economy. So things should get slightly easier for the consumer, slightly easier in housing and in those different areas. And so that will be an added tailwind that we didn't have last year. Secondly, the tariff effects were rolling through, if that makes sense. So the thing that delayed this recovery last year is sort of going away. And if anything, the Trump policies and the US policies are becoming much more stimulative here. So the depreciation allowances in the One Big Beautiful Bill, the deregulation to allow things to get built, the acceleration of M&A, et cetera, that's going to be allowed to happen is all very market friendly and capital friendly. So that's your third reason why earnings growth should get better next year. And then the fourth reason is some of the productivity gains that we should get from this AI technology. So this is really starting to happen. People are really getting good results here. We're seeing multiple companies that are growing their earnings, accelerating earnings and revenue without adding new people, without adding new costs. Now, from our point of view, is the multiple going to go down or up from here? If anything, it's probably going to go up because interest rates are going to be lower. So from that point of view, you're getting comfortable support from earnings. You're potentially holding the multiple or it's going higher. And so that does equal a good outlook. And it's not just in the US. You see this in Europe and the UK also, and you also see that in China where these economies are coming off a very low point. And so from our point of view, ultimately very positive about 2026. And if anything, it should be a little bit easier than last year was because we won't have all those twists and turns that made it a particularly hard episode of the A-Team.
So it sounds like you're feeling relatively positive about the US economy. What other catalysts are you looking out for next year? The US will have a new Fed governor, and do you think the US midterm elections will be good or bad for markets?
And okay, here's another narrative. So the narrative for next year, and these things come under this thing where the Trump administration or the US is going to run it hot. That's the narrative. And I sort of agree with this. So the reality is Trump's leaning on the new Fed governor to lower rates faster, okay? Faster than they probably should. And similarly, as you go into the US midterm elections, you're seeing them pull back on some of these tariffs around cattle and avocados and et cetera. And you're seeing them pull back on, try and help the lower end of the economy. And so from that point of view, they're going to run it hot next year to make sure that the midterms go well. And then ultimately run it hot all the way to the next presidential election to make sure that the MAGA base, depending on who you think that is, stays in power. So this is this run it hot narrative, and to be honest, we agree with it. And so from that point of view, we would lean into that. I agree there will be long-term consequences of running it hot, and I definitely think that's something we need to think about, but I think it's something you need to think about closer to the next presidential election, which is still 3 years away.
So how are you positioning the portfolio for early next year and the rest of the year?
Yeah, so it's sort of back to the plan of 2025. You want to think about running diversified portfolios across a range of different areas of structural growth. One of those areas of structural growth we still think is AI, okay? So we're not, getting off the spending here. We think the spending will continue. So we think the earnings growth for the enabler AI will continue. That's areas around the consumer where, companies like SharkNinja that we liked a lot last year obviously got a bit skewered by the tariffs. We're ultimately looking for a good return out of that this year and some of our other consumer ideas. On top of that, you'd be looking for this power theme to really kick in next year as we try to connect all these data centers. On top of that, we think some of this defense spending will continue to accelerate this year. So from our point of view, we're looking for, a broader, more diversified portfolio, potentially a lower multiple portfolio as well, so that you can take advantage of this cyclical upswing. That's essentially the plan. Does it pan out? Is there something else that skewers us like it did or that sort of punctures the economic recovery next year like it did in 2025? That could easily happen. But at this point in time, it definitely looks more likely to happen this year than it did last year. But I'm just cognizant. I said the same thing last year and we had to find our way through it. If it doesn't happen, we're going to have to find our way through it this year as well. But I think it is more likely. And so that's why we feel, I suppose, a bit more relaxed about the outlook in 26 than we were, say, in 25.
And as you mentioned, our investment process is really set up to help you with those twists and turns, and that's what the stop loss process is for.
Correct. Yes, and I'm not saying there won't be twists and turns. There always is. It's sort of Donald's Rumsfeld. There's the known unknowns, known knowns, known unknowns, and unknown unknowns. It's always the unknown unknowns that get you. And that's what the process is set up for, and it got us through this year. I'm sure it will next year if the unknown unknowns turn up as well.
So we are coming to the end of the episode. I was just wondering, are there any overarching messages that you would like to leave our listeners with? It can be for the year ahead, it could be the year behind, it could just be in general. Any lasting messages?
So from our point of view, I'd just go back to what I said around this narrative stuff. Like, yes, the narratives are getting louder. Companies follow earnings in the long run. That's what happens. Our job here at Munro Partners is to identify the areas of structural growth and identify the winners. If we can identify that area of structural growth, that'll equal structural earnings growth, and that earnings growth will equal share price growth over the long term. That's what we're trying to do on 3 to 5 years views across all our funds. Every company we invest in at Munro is generally growing its earnings at 15% per annum or better. That's ultimately how we get the 15% per annum returns roughly across all our funds, because that's the earnings that they follow. And so from our point of view, as we look into next year, earnings growth will actually be better next year than this year, or should be, barring anything unforeseen. And I just encourage investors to not get too sucked into these narratives, because the narratives will keep changing. Earnings growth is what ultimately drives stock prices. And so from our point of view, provided we lean into our process here and then manage the risk accordingly, we don't see any reason why we can't continue to produce the results that we have in the past into next year and beyond, because the big macro dislocations are probably a little bit further out from our point of view.
So since you mentioned it, what are the known unknowns that you're preparing for, or what part of the soap opera are you preparing for?
Well, not the known unknowns, the unknown unknowns. The only other thing I'd leave investors with outside of obviously just earnings growth that is our process is next year, these big AI models that these guys have been building are actually going to drop. So a big, million GPU Blackwell model is going to drop, halfway through next year, and we're fascinated to see what these models are going to be able to do. And so from our point of view, we are moving very much into a non-linear world where disruption actually accelerates. And it's going to accelerate because of these big AI models that drop. And so, just cognizant, I understand that some people think this is over. We're very much of the view that it's actually just about to get exciting, if that makes sense. So as these models drop, they're going to change, how we do things quite dramatically. And as they change the way how we do things dramatically, that's going to create a whole bunch more opportunities. And so if of the unknown unknowns, that's the one that we're most excited about. And the one you should be most worried about is if they have to hike rates. I mean, obviously a lot of what we talked about involves rates being flat or down. If they had to hike rates, then that would be the unknown unknown that would change things. We don't see that today, but those are the two things you want to be thinking about, or that we're thinking about a lot as we go into 2026. One's a negative unknown unknown because, may as well be honest and say they're the things that we worry about. The other one's going to be hugely positive. And honestly, I definitely would lean into the positive here. I think we're at a time of profound technological change, and one that's going to create amazing opportunities into the future, and something that I think you should definitely take the glass half full approach, not the glass half empty approach that people are taking today. And I can't wait to see how it's going to work out.
I also can't wait to see how it works out. Nick, thank you very much. And I look forward to sitting down with you throughout 2026 to hear how it's all going.
Thanks very much, Taylor.
To all of our listeners, thank you for tuning in to all of our episodes this year and for your ongoing support. From everyone at Munro, we wish you a safe and joyful festive period. Thanks very much.